So if we could switch over a bit to monetary policy issues right now. Earlier this week, Ben Bernanke announced that the Fed would keep interest rates near 0% until at least mid-2013 due to an outlook for an even slower economic recovery, which you just spoke about. He also mentioned that the Fed has a range of policy tools that is prepared to employ. What types of tools is he referencing? Are we likely to see another round of quantitative easing? And if so, at which point in time will he utilize these tools?
Well, let's, again, I'm going to answer that question, but in a roundabout kind of way. Let me begin by saying that monetary policy really has got to the point where it probably has limited ability to have any substantive impact on the economy. And that's because monetary policy works through the interest rate mechanism by reducing the cost of credit. And at the moment, the credit system in many respects is broken, which is to say it doesn't matter how low the interest rate goes. People still won't borrow or people won't lend. So that's part of the Fed's problem, is what can they do? And the tools that they have left really are more aimed at inspiring confidence in the market than it is actually in changing the demand for credit. So the tools that they have, again, very limited number of tools, but the first tool they actually did invoke, which is to be more specific about the time frame where they're going to keep an accommodative monetary policy, mid-2013. And indeed, in the immediate aftermath of that, the long-term Treasury rates traded down by 15 to 20 basis points. So you did get an immediate benefit by flattening out the yield curve. In a similar way, the Fed could, as the principal matures on the quantitative easing that they've already done, they've already committed to reinvest it. They could reinvest it in longer maturities. Why would they do that? They would do that, again, to flatten out the yield curve. Right now, everything out to 2 years, because of this extended, we're not going to raise rates for 2 years, you can get a 2-year Treasury at under 20 basis points in yields. So there's not much further that you can do there. But if they reinvested in, let's say, 10-year, and took it out of 2-year, it's called Operation Twist. You're flattening out the longer end of the yield curve, and that would hopefully bring down mortgage rates and things like that that are longer maturities. They could also reduce the interest rate that they pay on excess reserves. And it has to be on the list because it is an option, but they only pay 25 basis points now. And they could reduce it to 0, I suppose, but it's unlikely that would have a very large impact. And of course, then that leaves you with the question you asked: what about the third round of quantitative easing, build up the balance sheet even more? Looking back on quantitative easing, you could say there's been 2 rounds, and we are where we are, and what good has it done? And you could even be more negative and say, what bad has it done? And on that side of the equation, the quantitative easing, and Chairman Bernanke said it himself back when the program was first introduced, the second round last December, that part of the intent was to push up the value of risk assets, namely stocks. And it did do that for a period of time. Absolutely. All right? And the whole notion behind doing that is that people feel wealthier and they spend out of wealth, and somehow that will help kickstart the economy. And it did have that impact for a period of time, but now as we're witnessing with the market volatility and the downturn, it was a temporary phenomenon. And so the question has to be raised, was that really effective in a long-term way of getting the economy going again? It doesn't appear that's the case. So you could do quantitative easing, and the financial markets certainly want it, because right now, with all the turmoil and the negativism, if the Fed would simply announce doing that, I do think it would change the emotion in the market, and it would be a positive from that standpoint. But whether it would have any long-term benefit is another matter.